I guess what we're saying is we're entering an age of serious volatility, and you might start seeing other $100 moves during the day.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning. I'm Vince Lanci, and this is the Gold Fix Morning Market Rundown. Today, we'll call it a morning for the ages. The dollar is 101.80 and change, down 1%. The S&P 500 is 53.50, down 2.25%. The VIX is 36.98, up almost 10%, 2.5 vols, 3.5 vols, give or take. Gold is 31.25, up $42 on its highs. Silver is 30.94, down a penny on its highs of the evening as well. Copper 4.34, down 8, down almost 2%. Look at that complex there. That's stagflation. Gold is up, silver's undecided, and copper's down. WTI is down as it should be at 60.69, down over 3%. Natural gas is 366, down 1.5%. That's noise these days. Bitcoin 81,500, down $1,000. Palladium 925, up 4. Platinum 939, up 7. Gold, silver 100, spot 91. Grains are all, they should all be up. Yes, 1014, corn 472, wheat 557, up 7, up almost 4, and up 5. You're going to see China go out there and start front running to buy grains. So that's the whole stagflationary impulse. Okay, a morning for. These are a couple posts that we did yesterday. A day for the ages, which was basically a compendium of everything we did, plus a recap, plus a trade blotter for the day. This post just went out this morning, top left, unlocked. Goldman sees 4,500 tail risk in 2025, raises all targets. If you're caught up and you feel like you understand what happened the last couple of days, then you should read that. Earthquake, dollar crisis spikes. That's what we talked about yesterday. Yesterday's stories. We just talked about the Goldman story there. China is prepared to properly decouple this time. That's a story by one of our founders, a Chinese. He's not necessarily Chinese. He's in Asia. He's China-based. He's prepared. He's talking about China's willingness and ability to decouple from the rest of the world this time, and he lays out a pretty good case there from one of our founders, shared with everyone here. Technical comment: there might be only one now. That's I'm paraphrasing Michael Oliver, who put out a note to his subscribers yesterday, of which we are one, saying that he may have to change his feeling about bonds. He thought there might be a bond bounce, but the point is there might be only one now. Safe haven, gold, right? Safest haven, let's put it that way. Bank of America says bonds don't make sense if stagflation. We really like that piece. It was pure equities, but it went through the problem, why bonds are not really good in this environment, and then statistically lays out what did well in the 70s under a stagflationary environment. And pure gold plays are in there. Earthquake, dollar crisis spikes, gold 100. That was yesterday's morning rundown, and then a day for the ages. Okay, let's get to what we like to talk about today. Yesterday, the world is pulling out capital of the U.S. across stocks, bonds, and dollars. Equities were dropping, and bonds, instead of rallying as a safe haven, were also selling off. The obvious driver was China. Once it became clear that the U.S. would follow through with the 104% tariff on Chinese goods at noon yesterday, bonds began falling sharply. I'm sorry, noon 2 days ago. The market priced in expectations that China would respond by selling more treasuries. So treasuries started to also sell off. China is unlikely to devalue the yuan against the dollar. Not impossible, possible, but unlikely, at least in the beginning. Selling U.S. bonds supports their currency peg. So they would sell bonds before they devalued the yuan. That is likely what is occurring. The logic is linear. The higher the US tariffs, the more bonds China sells. It's a tit for tat, and markets are essentially front running it, but rationally. The secondary but identifiable factor into yesterday's and the day before's deluge and the current one that we're going through right now, because it's not over, is Japan. They too are selling US bonds and repatriating capital. And I say it's identifiable because of how the yen is acting. Uh, Mirroring China's likely actions. At times, China moves to preempt Japan moves to preempt China's influence. Japan may be ideologically aligned with us, but they're geographically aligned with China, and they have to get along. If you look at what happened to New Zealand and Australia economically with these news items, well, Japan has to take action. The broader trend is repatriation of global capital flows and payment chains. It's a financial onshoring movement in response to the weaponization of the dollar through tariffs. Gold benefits from this realignment. Side note, gold had a $100 day yesterday, higher. And when it was $100 off the lows, and I was awake, I tweeted, we're up over 3%. Gold is never allowed to go up over 2%. So is it allowed to go up over 2% now? No. I think people were panicking with other things, and they did not have time to keep their eyes on gold, or maybe the financial capital to keep their eyes on gold as well. Currently, the only safe haven for other countries in their minds are local currencies and gold. The US dollar is not viewed that way, and by proxy, bonds anymore. During US hours, price action was driven by reactions to Asia the first half of the day. US markets are now reactive, not leading. Gyrations reflect uncertainty. Will the Fed cut? Will Trump de-escalate? Will China respond? The result is volatility and confusion. So what happened to change the trajectory of worse feeling to one of the best days ever by every measure of the market, and one of the best days ever for both gold and stocks? Well, at 1:18 p.m. Eastern Time, Donald Trump posted on his platform that the U.S. would suspend reciprocal tariffs for any country that does not retaliate against his latest tariff actions. At that moment, with gold up $100 and bonds collapsing and equities in a deep red, everything reversed except gold. Gold has become a predictive asset, by the way. That's something we'll talk about another time, but gold no longer reacts. Gold gets ahead of things. But anyway, the tactic that Trump did, I think, was actually kind of brilliant. It isolates China while disincentivizing retaliation from others. The implicit message is if China absorbs the tariffs, others won't have to. But the first order message is this. I am now going to go full bad cop on China and full good cop on everyone else. He flipped his script, which is what we literally predicted he would do. Anyway, gold came off its highs but remained up over $80. Bonds recovered slightly. Yields were still up about 12 basis points when we looked yesterday at this framework. Equities surged. The S&P 500 was up over 8%. The VIX dropped 31%. I think it's its biggest move ever, one of its biggest moves ever. Last we looked, when we wrote this, it was at 35.7. Bitcoin was up 8%. Tech was up 10%. But here's the thing that makes the point about gold. Gold miners were up 9%. So what would you rather own? A gold miner up 9% or a tech stock up 10%? Well, you'd rather own a gold miner up 10% because its volatility is much lower. Perhaps we're entering the beginning of our own bubble in the gold market. But this is now a coordinated trade war, right? The US is using tactical tools, tariff waivers, equity support, to counter China's more strategic responses, which actually led the whole thing. Now, some takeaways from this. There's a clear domestic trend that remains, despite the stock reversal. American investors are rotating out of broad equities into gold miners. Now, I'm not telling you to go out and buy miners. I'm just making an observation. The immediate concern is stagflation. So while the world is worried about, while people like us are worried about the global dynamics, the things we like to discuss here, the big picture that will funnel down to the regular picture. Well, the regular picture is stagflation, right? So circling back a little bit to some of the stuff that was coming out of Zero Hedge. Yesterday's fund behavior was causative of yesterday's move. So Zero Hedge had been covering the large hedge funds involved in cross-border basis trades, essentially shorting yen, buying US bonds, and then using interest rate derivatives to hedge the bond risk, and then borrowing the money and yada, yada, yada. Basically, they were using them as collateral for equity trades, right? These are leverage trades, often 20 to 1. The structure is simple. Borrow cheap and buy higher yielding assets using international assets to borrow. The risk for those trades is structural, meaning these are international trades relying on stable FX and rate regimes. As those assumptions break, the trades come under pressure. Similar to what happened in 2019, the repo crisis. So the players are major funds like Citadel, Millennium, and others of that scale. Too big to fail is what we'd say. So yesterday summarized, so those companies got caught in between the nation states that were repatriating their money, right? That's my summary of it. But to zoom back out a little bit, payment chains are now onshoring. Nation states are onshoring payment chains just as they are onshoring and rebuilding supply chains. Leveraged funds got caught off sides, and we haven't even digested the implications for savers and consumers. That comes later after the fireworks are over. Payment chains are now onshoring, and that is very dangerous for the US bond market and the rest of the world in general, because if you compare this to, say, the Liz Truss moment, the mini budget, and it's a good comparison, the rest of the world said, we don't want to have anything to do with Great Britain for that moment in time. And in doing that, they repatriated their money, and then they put it into US bonds or they put it into US stocks or whatever, but they took it out. Now, if everyone takes their money out of US dollars to repatriate, to shore up, to fix their earthquake problems, their natural disasters, as I used as an analogy yesterday, well, you're taking money out of a global monetary system. It's not the British pound, which is not the global reserve currency anymore. It's the US dollar. So if everyone takes their money out of the payment chain, then the payment chain doesn't function. The payment chain is the plumbing, right? And if you get an air in the air bubble in the plumbing, well, the liquid's not going to flow and there's going to be problems. So that's where we are analogizing it. The outlook from here is, it's cliche, but it's true, volatility. Tariff ceasefires, which is what we're going through now. You'll see them talking, Europe is talking to Trump. Trade partner negotiations and attempts to isolate each other, the US and China, from the global community in different ways. Trump's horse trading technique is about to be center stage. I say the word isolating, for example, like this. The US is trying to isolate China by peeling away all other retaliatory tariff threats, right? And offering our payment chain. And China is has been peeling away U.S. supply chains by negotiating with Mexico for silver, okay, by negotiating with Brazil for soybeans, by getting supply chains locked up under contract. So no matter what happens, they have a flow of goods to make the products they need to make. So that's it. I mean, that's an assessment of what happened yesterday, without even touching on how cool it was that gold was up $100. Data on deck today: CPI, PPI is tomorrow. We sent out a report on that. Let's take a look at the markets. Right, S&P top left, silver lower left, and the Hang Seng index lower right. Okay, starting with the Hang Seng. Hang Seng is up, so whatever China is doing, whether it be buying their own stocks or doing economic maneuvers, their stock market likes that. Top right is gold. Just a quick comment on gold. That's the Polytrends product I have up there. Gold could drop $100 and things would be normal. That's the first thing, right? It rallied $100 yesterday. Gold could rally $10 and hit new highs in 15 minutes. That's my feel for it, although I don't have anything on to that effect yet. The S&P 500, take a look at the S&P 500 and silver. It's the same chart, except that silver leads the S&P 500 higher now, right? So silver rallied off the lows before the S&P 500 did, and I think that's because you just have too much selling. There's another concept we want to throw out there. Someone said it, I think it might have been Paul Tudor Jones years ago. Nothing happens below the 200-day moving average, right? And well, those moving averages there, the S&P 500 is all consolidating on the 200-day moving average. Let's for a second. You know, throughout history of gold, once it became a futures listed product, there was an unwritten rule probably circulated amongst the banks from the powers that be. Gold shouldn't go up more than 2% in a day. It can go up 20%, but no more than 2 in a day. We don't want headlines. We don't want big moves. And 2% usually was $20 and then $30. And now at $3,000, 2% is $60. So I've noticed that since we got to $3,000, there were hesitations to buy it up over $30. And so 2% became 1% for a brief period of time. Well, yesterday, you know, genie out of the bottle, the emperor is naked, however you want to describe it. Yesterday was a 3% move in gold, up $100 easily on the day, and off the lows by about $120. And nobody did anything to stop it. That's because they couldn't. Because while gold is probably the most important store of value now, at least definitely as an indicator of what the rest of the world wants to do, everybody, funds, governments, were looking at dollar risk. They may be buying gold and driving it up 3%, $100, but they're worried about everything else they have. And everything else they have took precedent. So the point is, you know, the seal is broken and gold is now going to be able to go up $50, $100. You know, it'll always be able to go down $100 because that's what they want. I guess what we're saying is we're entering an age of serious volatility. And you might start seeing other $100 moves during the day, probably starting in Asia. The final thing I want to say is, if you're a gold person, for the last 10 years, it's been buying during Asia and selling during the US. There are plenty of good charts out there. James Anderson has been really studying that for a long time at SD Bullion. And look at what happened yesterday. Same thing, just now the Asian buying sticks better, right? Buying during Asia, selling during Europe for 2 hours, an hour maybe, and then selling during the US, but then then at the end of the day, people are reticent to really slam it. So the pattern is still there. Buy it during Asia, sell it during the US. but don't go home short anymore.
Well, thank you, Vince, for this morning's Markets and Metals. Sure hope you enjoyed that and been finding it helpful, especially with all the chaos that's going on in the markets. And in either case, I sure appreciate you watching at home. And before we wrap up, would also like to thank First Majestic Silver, who brought us today's show. And First Majestic just had their production report out for the first quarter, where they came back with 7.7 million silver equivalent ounces. And the breakdown of that comes in at 3.7 million silver ounces, 36,469 ounces of gold, 12.5 million pounds of zinc, and 7.5 million pounds of lead. Obviously, that production has been boosted by the Gatos deal and the acquisition of the Cerro Los Gatos mine, which has resulted in record silver production of 88% year over year, a 49% increase year over year in silver equivalent production, and continued exploration activity as First Majestic completed a total of 61,219 meters of drilling across its mines in Mexico, and they are also near completion of their conversion to liquefied natural gas at San Dimas. So the link to this press release, so you can go through the full details, in the description field below. As always, thanks for watching. Hope you're having a great day out there, and we'll see you again tomorrow.
Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.